Hello.
So I think I'll begin now. Isabella, may I begin?
Yes.
Yes, I will then. I hope. Good morning, good afternoon, good evening. We're all used to that opening salutation, but a heartfelt welcome to each and every one of you for joining us this afternoon. This is another in our series of the role of the state in economic growth. We've done this series in partnership with SIPA, the Columbia School of International Public Affairs, over the last 4 years or more, looking at global economic conditions in general, and especially some of the key emerging economies of the world. In this particular series, this semester, we're looking at global issues, but trying also to ground them in the experience of one critical emerging economy, which is Brazil. So today, I'm Tom Trebat. I represent the Columbia Global Centers in Rio de Janeiro. I will say just a word or two of welcome, and then my partner in this series, Jan Svenjar, will also speak on behalf of SIPA. Before turning these proceedings, we've got a wonderful panelist, a group of panelists here. We don't want to take too much time from them, but then Jan will introduce our moderator and host for today, Professor Patricia Mosser of SIPA. I'll only say that the Rio Global Center exists to create ties between Brazil and Columbia University and kind of all the issues that matter. And in this particular series and in this particular event this afternoon on global monetary conditions and the outlook for the emerging markets, we're very pleased to have the partnership of two very valuable partners in Brazil. They are the Centro de Debates de Políticas Públicas, CDPP, in the Brazilian acronym in Portuguese. And Ilan Goldfein represents the CDPP on this call. And then also the Instituto de Estudos de Política Econômica, better known in Brazil as Casa das Garças. And I'd like to welcome Edmar Baixa to the call, and both for CDG, the Casa das Garças and CDPP, welcome all your members, and thank you very much for your partnership and your support as we look at these critical issues. So with those brief words of welcome from me to all of you joining us on the call, I'll pass it over to my partner from SIPA, Jan Svenjar, for his introductory welcome remarks. Jan.
Thank you very much, Tom, and let me welcome you all on behalf of the Center on Global Economic Governance, which I'm directing at Columbia at SIPA. It's a pleasure. We've had this series on the role of state in economic growth, economic development for the last several years, and one of the most important parts of it has always been the collaboration with Tom Trebat and the Columbia Center in Brazil, together with the local institutions. And indeed, this spring, we are having a series of roundtables, panel discussions, dealing with crucial issues around the world, with a particular focus and example of Brazil in the case of the emerging markets. And it's really a great pleasure to have two colleagues, Patricia Mosser and Guillermo Calvo, among us in terms of the focus that we have today. And Patricia will be the one who will direct, chair, and moderate the session. And I'd like to welcome you all, both students, faculty, and friends of Columbia and the Rio Center to this roundtable, which promises really to focus on one of the most important issues which we have, namely the role of central banks' monetary policy around the world, which both has an incredible track record, and a lot of expectations in terms of where these institutions will take the world economy. So we couldn't be more fortunate than to have the panelists that are on the panel today. Patricia, thank you very much. Take it from here.
Wonderful. Good afternoon, good evening to everyone. My name is Trish Mosser. I am the director of the MPA in Economic Policy Management at the Columbia School of International and Public Affairs. I also direct the school's initiative, particularly relevant for today, on central banking and financial policy. This is the third panel in this year's conference, virtual this year, of course. And the topic today is global monetary conditions and implications for emerging economies. I want to thank Jan and Tom, as well as the other sponsoring institutions, for inviting me to do this. As we all know, restoring global growth in the wake of the pandemic, and particularly in emerging economies such as Brazil, is absolutely critical. And while the public health crisis is first order, the other policy institutions, central bank, fiscal authorities, and so forth, are playing their roles as well, massively increasing aid, liquidity, and credit to the financial and the non-financial sector. Now, of course, the quantity of that is particularly pronounced from the advanced economies, but it's happening all over the globe. So our panelists today are going to look at the major monetary and fiscal policy actions and dilemmas about what is needed and what's possible to spur global growth, with particular emphasis on emerging and developing economies such as Brazil. We have 4 great panelists. I'm going to introduce them briefly all now so we can just then get going to the substance. The first speaker is Seth Carpenter. He is the chief US economist at UBS. But Seth has had a long distinguished career in the public sector. Seth was the Deputy Assistant Secretary for Macroeconomic Analysis at the US Treasury and was nominated by President Obama to be the Assistant Secretary for Financial Markets. Prior to that, he had a 15-year career as a central banker, though, and was the Deputy Director of Monetary Affairs at the Board of Governors of the Fed. The second speaker is Francesco Papadia. Francesco was one of the designers of the monetary policy framework for the European Central Bank. From 1998, even before the ECB was the ECB, to 2012, he was the original Director General of Market Operations at the ECB, and he had previously had a career at the Banca d'Italia as well. In subsequent years, Francesco has done a wide-ranging work on macroeconomic policy, both globally and in the Euro area, has written 2 books that include work on central banks and on governance as well. The third speaker is my colleague, Guillermo Calvo, who doesn't really need an introduction. He is obviously a professor at the School of International and Public Affairs at Columbia. He is a world-renowned expert in the macroeconomics of emerging market and transition economies. He's had dual careers in both academia and the public sector, at Maryland, at the University of Pennsylvania, at Columbia, of course, and then in the public sector at the IMF, as well as the Inter-American Development Bank. Last and certainly not least is Alain Goldfein, chair of the board of Credit Suisse Brazil. He's the director of the Center for Public Policy Debates, but particularly importantly, the former president of the BCB. He similarly has had a very wide-ranging career from the private sector to academia to the public sector, including at the IMF and the World Bank. And without further ado, I'm going to turn it over to Seth. You're up.
Excellent. Thank you, Trish. It's an honor to be with such esteemed colleagues on this panel, and thank you to everyone who's in the audience. So I think the remit was to talk about central banking, central bank liquidity and markets. I thought I'd do a little bit of start off of what's different this time versus last time. So the Fed's doing a large QE program now, obviously. Trish and I were both working for the Fed, Trish in New York, me in Washington, following the financial crisis when the Fed was doing large scale asset purchases, and now everyone just calls it QE. And so I thought I'd talk a little bit about the difference there. I will admit to having my whole career having been fairly US centric, but I think there are a few places where the overlay or the spillover to emerging markets, in particular Brazil, could be particularly important here. At least one that might not be obvious. And so I'll try to touch on that a little bit, maybe stray just a hair into some other people's sandboxes with some marks, but that's where I'm going to go. So what's the Fed doing now? I mean, I think it's pretty remarkable. $120 billion in QE purchases each month, 80 billion of treasury securities, 40 billion of mortgage-backed securities. To put it into context, following the financial crisis into the early, 2010, 11, 12, 13, the peak of monthly purchases was $85 billion a month. So at least by that metric, it's a lot more. The logic, however, is actually a little bit different this time around, which I think matters in some ways expected, in some ways unexpected. So then the theory of the case was primarily that short-term interest rates were at zero. The committee had taken the target for the federal funds rate to 0 to 25 basis points, but longer-term interest rates were above zero. And so by buying more longer-term assets, treasury securities in particular, and some mortgage-backed securities, you could extract duration risk from the markets, push down longer-term yields, maybe make the relatively risk-free return lower, pushing people's portfolios into riskier assets and easing financial conditions in that regard. I think all of that logic is still to some degree at play, but now it's a little bit more vague, a little bit broader perhaps for the Fed. I think the key example of what it is that was different then versus now is in 2012, 13, the Fed began what we called at the time the maturity extension program. The markets called it Operation Twist Part 2, where they were selling, the Fed was selling short-term securities and buying longer-term securities. So the size of the balance sheet was not the point. It was the result, but it was not the point. The point was to push down longer-term yields. Now, the Fed is buying $80 billion of treasuries each month, but all along the coupon curve from 2s all the way out to 30s, despite the fact that short-term interest rates are zero, despite the fact that short-term interest rates are at zero for 3 years. Their argument is that they're trying to ensure market functioning while simultaneously easing financial conditions. And so if I am allowed a bit of editorializing at the expense of my former employer, I find their argument a bit thin. I think financial conditions in March of 2020 were clearly strained. They'd been quite good for quite some time. And so I suspect it's a bit of bureaucratic inertia that has left them in roughly the same place for the purchases. But I think that matters for reasons that I'm about to get into. So the scale is different. Maybe if you were to resize things relative to the size of the economy or size of the overall financial sector, it's about the same or not. But I think the part that matters here in particular is one of the places where I think for a generalist audience, maybe some of the intricacies are a little bit lost. So when the Federal Reserve, or indeed any central bank, buys securities, conducts a quantitative easing operation, they take from the market a security, say treasury securities, and they provide to the market cash, but it happens in a very specific way. In the United States, the only way for that cash to get to the market is for the Fed to create in the account of some bank somewhere reserves, so money that that bank now has on deposit with the Fed, and then whoever ultimately it was that sold the security to the Fed, be that a securities dealer or a hedge fund or a pension fund, that person's account at the bank is credited, and so the bank's balance sheet has now gone up, even if the bank wanted nothing whatsoever to do with this transaction. So the Fed is in the process of creating reserves by buying treasury securities and mortgage-backed securities. The previous peak in the first round of QE was $2.7 trillion worth of reserves in the banking system, which at the time we thought was astronomical. I literally remember the day when one of my research assistants had to recreate their Excel spreadsheet because there wasn't enough width in the columns that handled reserves. So when we got over $1 trillion. So the world was very different. Now that number is 3.4 trillion, so notably larger. March of last year, when Treasury market liquidity went askew, the Fed did a huge amount of purchases. But I think what's actually more remarkable is the path. So given a technical issue that I won't get into the details of, what the Treasury is going to be doing with its cash, with the Fed purchases, we're going to get to a point within a year where there's about $5.5 trillion of reserves in the banking system. To explain why that matters, in the US, at the end of last year, at the end of 2020, 1/4 of all banking assets in the United States, so take all the banks in the United States, 1/4 of their assets were reserves held at the Fed. So initially, and probably up to this point, that was probably good for liquidity in the sense that banks had a huge amount of liquid assets on their books. When it came to payment systems, there was no need for any sort of rationing. Payments could flow here and there, and no bank was ever going to get caught short. A funny thing about liquidity, I think any academic economist who studies central banking would have said there's no downside to increasing the amount of central bank liquidity in the system when it comes to payment systems and rates. But it turns out when you live in a world that has regulations and frictions, that's just not a true statement. And so what we've seen now with the Fed is that they've had to temporarily suspend or temporarily exclude from one of the regulatory calculations, the so-called supplementary leverage ratio, reserves held at the Federal Reserve. So there is an adverse regulatory treatment to the single most liquid and safe asset in the world for banks to hold it. That's a truly perverse outcome. Why should we care? Because when banks become constrained with the size of their balance sheet, even if it's because they have more and more of this truly safe and liquid asset, they're going to have to make harder decisions about what to do with their balance sheet. So one thing that a lot of banks do is engage in repo operations, repurchase agreement operations, where they allow some customers to borrow money against securities, others to lend securities against money. But that takes up a lot of balance sheet and it doesn't actually make them a lot of money. And so when you're constrained, that matters. So here's one place where there could be a very unanticipated spillover to EM. A big source of global transmission of financial linkages, of financial frictions, of financial tension comes through the cross-currency basis market. And that is another financing operation that banks do. And they do it mostly because they end up at most times having some space on their balance sheet. It doesn't make them a lot of money, but it makes their customers happy. Doing that for an extended period of time when your leverage ratio is binding is just not a money-making opportunity. And so one could imagine 6 months from now, 9 months from now, a year from now, as reserves in the banking system get up over $5 trillion, banks are going to have some very, very difficult and inconvenient decisions to make. And instead of the world being awash in liquidity, what we're going to find is the world being awash in US banks that are making difficult choices over what part of their balance sheet is actually worthwhile, unless we can somehow get to a political outcome where these things are reversed. So what's different in central banking liquidity now versus then? There's a limit to how much liquidity is actually adding liquidity. There's a limit to how much these operations are actually making markets more liquid. I think another place where I think this time could be a little bit different, and hopefully a lot different, and if it's not different, then it will have more adverse effects on emerging markets, is what happens when the Fed stops. So the Fed has said they're going to continue their QE purchases at the current pace until there is, quote, substantial further progress, unquote, toward their objectives. I love that phrase. It feels like the kind of phrase I wrote 1,000 times in memos where it can mean anything to anyone. But I think in practice, what this means is later this year, and I will admit I'm slightly on the early side relative to the market, but I think by the time we get to the September Fed committee meeting, they will have seen 6 to 7 million new payroll jobs created out of the 8 or 10 that Chair Powell keeps saying have been lost. They will have seen over 300 million Americans having been vaccinated, which basically means anyone who's not saying that they're never going to get a vaccine will have been vaccinated. We will have seen inflation rebounding off the bottom. And so I suspect that's when the Fed actually makes the announcement that they're going to start to taper. The market's trying to figure out where that is now. We've seen Treasury yields rise over the past several months, but particularly over the past 2 weeks. And a taper tantrum like we saw in 2013, where it was 150 basis points, has global ramifications. And I think one thing any global markets observer has noticed is that when markets move that dramatically in developed market economies, they tend to impose potentially very strong costs on a lot of emerging markets. So I think that's one place where hopefully this will be quite different than the last time, but a taper tantrum, I think, is quite possible. Maybe it's starting to play out now. And if it's starting to play out now, then you should actually feel a little bit better because it may on net be smaller and drawn out over a longer period of time. But I think that's one area where markets really need to pay attention. And I think EM markets in particular. I think now just to take that view and make some final closing comments, that same taper tantrum experiment that we're talking about with the Fed now, I think has the risk of being bigger than last time. I'm hoping it's smaller because people have lived through it, but because the dollar amount is so much larger, the adverse effect could be larger. Looking at other central banks around the world, I think of the Bank of England, where they aren't doing anywhere near the same notional dollar/pound amount, but they're doing a lot more in terms of just duration. And so you could easily imagine a stronger adverse market reaction when they taper. And again, global markets are linked. The ECB, and obviously Francesco is the expert here, but I always found it interesting to compare notes with my colleagues at the ECB because the Fed never had to deal with the question of what happens to peripheral spreads. That's clearly a constant consideration for the ECB. And so I think when and if we get to the point where they're thinking about changing their stance, that's a consideration. And again, different spreads, different markets, how the market reacts to those risks could easily spread to emerging markets. And I guess the global issue really is there. We know that global markets are linked. We know that the Fed tends to drive lots of market rates globally. And we're entering now, I think, into a period where one wants to be very, very attentive to these sorts of decisions. Lots of volatility is almost surely going to be upon us for the next 9 to 12 months, and the spillovers could be big. So let me stop there.
Okay. Thank you, Seth. Francesco, the floor is yours.
Thank you very much. Let me share my screen. Voila. I hope you see that now. So first, a little preliminary comment. I think central banks are playing now third fiddle. The first fiddle is COVID and vaccination. I think that this is the leading factor in economic developments over the next 12 months or so. And the second fiddle is fiscal policy. I think that in the order of macroeconomic action, central bank's monetary policy is taking a second role with respect to fiscal policy. I must say, I wouldn't have minded being a third fiddle when I was active in central banking, because I found that being first fiddle was not the most convenient place where to be. But right now, I think central banks are third in the ranking of moving markets. What I would like to cover in my 10 minutes or so, just look at the exceptional monetary conditions in advanced economies. What is the current impact on emerging economies of these exceptionally monetary conditions? And then touch, and I think I would follow up on what Brad said. What about exit? What will happen when exit will come? So exceptional monetary conditions in advanced economies, balance sheets have grown by 10, 5, and 6 times respectively for the Fed, the ECB, and the BOJ, and this number keeps growing, as Brad reminded us by the day. What does that mean? The fact that a large part of this increase of balance sheet meant that central banks bought a very large amount of government paper. I think that means that while institutionally you could still say that monetary policy and fiscal policy are separate, in practice, there is no separation. I mean, the central banks have become much too large holders of government securities to really say that the two policies are separate. Yield curve control is only formally pursued by the BOJ, but I think that if you look closely what the Fed, what the ECB, what the UK central banks are doing, looks similar, analogous to yield curve control. Of course, we know that we have interest rates which are as low as they have ever been. I think Trish mentioned a book of mine. I've tried to look at interest rates from Babylonian times to now, and I'm not sure that I found interest rates at zero, nominal interest rate of zero or negative. And of course, there is also something else that is new in central banking action, which maybe doesn't have so much of an impact on emerging economy. Contrary to tradition, central banks have clearly entered the business of resource allocation, including on the green issue. They care about income distribution and are busy on fintech. And if you think of a central bank digital currency, you get a proof of that. But again, these issues are maybe less relevant for emerging economies. Now, what are the consequences of this for emerging economies? Well, I would say so far, mostly favorable. Easy global conditions, easy global monetary conditions alleviate the severe COVID crisis in advanced economies, and monetary easing in conditions of low inflation in advanced economies helps monetary easing in emerging economies. And we know that in different form, in different quantity, many emerging economies are also on a very easy monetary path, on a very easy monetary stance. And specifically, low rates on advanced economy help low rates in emerging economies, and this reduces the debt burden, which is increasing everywhere, including in those emerging economies that can afford increasing their debt burden. Not all of them can, because some of them have no space to increase their debt burden, their debt to GDP ratio, but in those that can increase low rates as favored by what central banks in advanced economies are doing, are helping reducing the debt burden. And this also applies to equities in emerging economies. And of course, as of now, there seems to be limited risk of a premature exit, even if I will say something about this in the next slide. There is one worry, though, financial stability risks. And central banks have the usual story that, oh, yes, of course, if we have a financial stability risk, a macroprudential policy will take care of this. But my understanding of the state of macroprudential institutions in the United States, in Europe, is not very reassuring from this point of view. I doubt that really macroprudential policy could take care of severe financial stability risk that we have not seen so far, but could come. What about exit? If you look at central banks, and of course we heard from Brad about the Fed, this is far away into the future. And I think that when it comes to the ECB, given the distance that there is from their inflation objective, you could say, well, yes, objective conditions say that the ECB is not likely to move away from its stance, to tighten its stance in the foreseeable future. In the case of the Fed, I think it's not so much, and here maybe I'm a bit critical, it's not so much an objective reading of the situation, but it's just the interpretation of the situation that the Fed gives. It seems that inflation and overheating are not an issue. The chair of the Fed has said we are not even thinking of withdrawing support. And of course, average inflation targeting gives room for this kind of attitude. But markets, and again, Brad referred to what has been happening to the bond market over the last few weeks, may see things differently. And this is, of course, a very important issue to take into account. Markets don't seem to be as relaxed as the Fed is about inflation, about the possible need to change the very accommodative stance that the Fed has. But in any case, we know that exit will eventually come. It's not clear when. But it will come. And what could be the effect? The first thing to say is that effects will be different. China, to surprise of many, including myself, is putting up a strong performance. There are some countries in the emerging market sphere that have sound macroeconomic conditions and are growing, or at least were growing before COVID and could start growing after COVID. Then there are less solid emerging economies which have fragile macro conditions and hesitant growth. And then we know that there may be specific sectoral hits. Global value chains could be affected. Energy could be a source of weakness for some emerging economies. If exit comes, we know what could happen because we have seen that happening in the past. We could move to a risk-off situation. We could see large increases in yields in emerging economies, both because the basis, I mean, the Fed the treasury yield that will grow, and because of the spread will grow. This will create debt sustainability problems, capital flows stops, bankruptcies and financial stress. Of course, the exchange rate could act as an offsetting factor, but of course, this would have a cost in terms of inflation. So will not be a totally protecting factor. Okay, if that is what could happen when there is an exit, then the question is, what can be done? Well, the first thing I would say, think about it. I find that this idea of not thinking about it is not very wise. I would think about it. I understand what's the meaning of not thinking about it, and I trust that indeed people at the Fed are thinking about it, even if they say the contrary in public. But I think that it would be more prudent to think about it in advanced economies and in emerging economies as well. And then I would say use the time between now and exit to promote growth. I've become fixated over the last time about qualitative fiscal policy. So not necessarily changing the balance, but changing the composition of expenses and revenue in order to favor growth, in order to get green, in order to fight inequality. I think that there is a lot of room there to change and improve while maintaining the balances. structural measures, which are economically easier when you have a good macroeconomic, good financial conditions, but politically more difficult when you have easy monetary policy. And then my last point about what can be done is regional and global coordination. And maybe I would put a little more emphasis on regional, because global, I think, is more difficult to engineer and to use. So these are my thoughts and my contribution to this discussion. Thank you very much.
Thank you very much, Francesco. First of all, I want to also encourage all of the participants to enter any questions that they have into the Q&A tab at the bottom of your screen. I may have a question or two after the panelists get done, but then we'd like to open it up to everyone else. So if you have questions, please send them in. I will do my best to get to them when we get to the Q&A part. And with that, we'll turn it over to Guillermo. It's all yours.
Okay, let me see if I can. Yeah, I think we are. Can you see me? Or my presentation is already there? Okay, great. Give me a second. Okay, good. Well, thank you very much for the invitation. This is just a treat to listen to people who really know about central banks. I've been close to central banks, but not inside. I'm not an insider, and look at all of this more from the point of view of an academic, if you wish. But I was very pleased to hear that the topics that I find very key to the present situation have been raised in different forms, but essentially the same ones are there in the front line. So I have a few slides that need some interpretation, but let me go through them in some fashion. In the first place, I think we are facing something that we haven't seen before. We have to admit that. I mean, this is a liquidity shock that we've never seen it like this. And the previous speakers gave very good examples about that. So I find this simple figure quite revealing. Here you have two curves. One curve, this one, the blue one, is money supply, let's call it, measured by M1 in the United States. And the other, the red line, is the GDP in nominal terms. So when you look at history before the Lehman crisis, say, you see that there's quite a correlation between the two. And this is broken in a very sharp, uncivilized way by this. And we haven't come back to that. We are still there. And what is the theory? Well, being an academic, I think a lot about theory. And when people say, well, you see, what you're seeing is a flight to quality because of this and that and so on. And then you wonder, what do you mean by quality? Having greenbacks, is that quality? Is a greenback itself? Is an entry in the central bank balance sheet? Who will give me coffee if I pass by the Fed in Washington and I feel like having a cup of coffee? Can I go inside and say, look, I have a greenback, give me a cup of coffee? Of course not, it would be crazy, right? So the flight to quality, that's the stuff that I'm thinking, I'm very obsessed about, is something that has to be defined. And now in some of the comments that were made, and some of the facts that we know very well, for example, we talk about liquidity. We used to say, and when you talk to people in the Fed and they talk about treasury bonds, not now, but in the past, they kept on saying, well, that's a holy asset class. It's a liquidity, you couldn't think of something more liquid, more sure, and so on. Now we have second thoughts, right? We've seen what happened in March and so on, going back. the taper tantrum. So what happens with the Treasury all of a sudden? And now we hear Seth Carpenter saying something that I didn't know, that some of the regulations are sort of interfering with the liquidity of high power money. That I really thought was very close to God. And you tell me that, and it's quite possible, right? That by saying, look, don't touch it, I make it something which is very liquid, illiquid. So I think that's where we are. I think it's important to keep that in mind. And that's the main reason why when I look at this, another thing that we have been observing recently, and they ask me, what's going to happen? I said, look, like a serious scientist that I'm trying to be, I don't know. Because since we didn't see this before, this is very strange. I cannot use econometrics. I can use my intuition. I can develop a model, but you may believe in my model or not. So we live in a world where opinions could be quite different and quite reasonable at the same time. So that's why I find it very interesting. And in particular, if you want to just get a feel of how radical this is, here you see M1 growing in the span of maybe 1 quarter, 2 quarters by 40%. And what's interesting about this experiment is this is not a swap of toxic assets. We are not taking toxic assets from the market and pumping in this liquidity. In that case, maybe you feel comfortable that this is not inflationary. But if you are pumping in something which is not taking anything else away, it's much less transparent, at least, what's happening. So this is more likely, in principle, that we'll have some inflationary impact. So go one step forward and look at what happened here. We didn't see inflation, but we saw something that might be has something to do with inflation, right? You can inflate by buying goods. You can inflate by buying other liquid assets. So you diversify your portfolio and buy something which is not a real share in the usual technical sense, but it's another liquid asset going around. And this you see is happening now, and big way, increased 25% according to this index, when in the Lehman crisis and so on, you saw a dip as expected, right? So here we are in the deepest crisis that we've seen in our lifetimes and more, and we increase money supply, and what we get is this result. So that could be inflation. If I think of that, that's why I said it's a new inflation brand. And maybe there is another inflation at that time when you look at emerging markets. What happened to emerging markets? The first days, if you recall, people were really very concerned about how the spreads in emerging markets grew. And in a week or two later, they plummeted, and now they are below what happens here. So who is putting the money into these assets? Countries that don't have their own currency. I'm sorry, they don't have a reserve currency, and so on, and facing the same problems as the United States as advanced economies, and here they are. Let me try to go a little faster on this, because then you look at emerging markets. So when I say emerging markets are mimicking the advanced ones, we haven't seen that either. In the past, when there was something like this, you got a sudden stop in those countries. What did you get? Higher inflation, output went down, spreads increased. You don't see that. And something also quite remarkable, real monetary balances increased in the span of less than a year by 32%. In the US, it's even higher, right? But still, you wouldn't expect that people will hold more money when this happens. Of course, you can explain that because of the type of crisis. Some people held on to their money for precautionary reasons, etc. But this was big enough that when you compute, for example, I did this simple exercise. I said, well, let me assume that the increase in M1, you can use that seniorage, right? So divide that by the GDP, and you will have a sense of how much these countries could have financed by printing money. And then you remember, in the first place, Chile, 11% of GDP. I don't have a good explanation for that, but that's what the numbers tell me. Brazil is less, and Ilan knows the answer, I'm sure. But the whole, even Argentina is 5.2%. You wouldn't expect that, right? To see in Argentina, and so on. Peru, 5.4. These are countries that are immersed in a very deep crisis, and you don't see still the light at the end of the tunnel, right? And the concern is, this is taken from the fund, this is advanced economies, EM is emergence. Well, advanced economies have, according to the forecast, the fiscal deficit will be around 9%, but also for emerging markets. How are they going to finance that? I mean, you can understand the first year, the crisis, we can elaborate on that, but we don't have time. But 2021 now, it's a different ball game. And again, the case of Brazil, it would be interesting to discuss. So here is a concern. These countries don't have reserve currencies. Maybe some of them, like Chile, have something close to that because of a relatively long history of very good macro policy, maybe. But I think they are more the exception than the rule. So I think the problems that we discuss here in the States, and I didn't want to address the risk of inflation and so on, because those issues in the US and so on, because those issues are being addressed by the other speakers. There are problems there in the advanced countries, but the problems are even more transparency. I mean, there's less of a debate about this, that continue doing this kind of, having this kind of deficits will run these countries into a very difficult situation. So I think the risk of inflation and financial instability in those countries is now increasing. And it could get much worse. I don't want to enter into the discussion if inflation is a real threat, but Francesco talked about regulation and how regulation could develop in cases where you have a problem. We don't know. I mean, I don't know what the Fed will do. As Francesco said, if I remember correctly, we know what they say now. What they will do if they are pushed into a difficult situation, if inflation rate starts really increasing in a threatening way, well, quite naturally, they will react in ways that they don't want to speak about now. So, and when that happens, of course, when your home is in, or has been in my case, in emerging markets, you remember Volcker, right? I'm hoping that Volcker will not happen. But you know, you can get Volcker much closer than you think. If instead of thinking about spreads as we usually measure it, you think about spread as a ratio, because the interest rates are so low now that as a ratio, a 2% increase, that reduces the value, present discounted value of assets. So from a liquidity point of view, a small enough, a very small increase in interest rates in the United States could be devastating for emerging markets. And that's the reason, I think, what people, when they see that interest rates may increase just a little bit in emerging markets, they run out of the door. Because it's not a psychological thing. The liquidity value of the assets can collapse. Let me see. And by the way, momentarily, inflation, just to show that we haven't seen this before, inflation has been going down. So, and we can explain that. I don't think this is a measure of credibility. I think it has a lot to do with the monetary dynamics, so to say, of monetary dynamics of the pandemics. People holding on more precautionary money and so on and so on for a while. So that's essentially my presentation. I agree totally with what the previous speakers have said about, I mean, the risk from the point of view of the United States is the risk of inflation, certainly. I'm less concerned about that, as most people I think would agree on that. But remember that there was also inflation in the asset market. So if there is a sudden contraction of the value of this crash in the financial, in the equities, that could have a very large effect. I don't know how large in the United States, but certainly that would have very serious repercussions in emerging market. So that's what we are. And again, fortunately, if I were a policymaker, I would say, very hard to know what is the proper thing to do because we don't have much experience. Except when you go back to the 30s, but we partly solved the problem by Second World War. I hope we can do better this time. Thank you.
Thank you, Guillermo. So just a reminder again, if people have questions, please send them in through Q&A, and I will try to get through them when we're all done after I've asked a question or two. Last and certainly not least is Ilan.
So thank you very much, Patricia. It's a pleasure to be here talking about the global monetary conditions, especially the implications for emerging economies. I would like to thank the Columbia Global Center, the Center on Global Economic Governance at Columbia, at SIPA, and of course CDPP, where I'm from, and IEP Casa das Gasas, which I'm also one of the partners. So it's a really pleasure to be here. What is my role here? To tell you about what is the impact of this to emerging market, and especially to Brazil. What do we have now? We have an unusual expansionary global monetary conditions. I mean, the previous speakers, Francisco said, Guillermo, they showed very clearly that we are in a different world, a world of very expansionary policies. For how long? That's the big issue here. We don't know. What other speakers have mentioned, and I would like also to stress, is that the issue for us is what is the impact of the exit? Of course, you could comfort yourself saying, well, we will never exit, it will never end, we have the new normal. But the experience of the past have taught us that we should think about it. As Francisco ended, he said, well, we need to think. And what does it mean to think? Is to say that first, we are under very low real interest rates globally in a context of very expansionary fiscal policies. So it's a very different world that we're facing. And where we can see it very clearly is in asset prices. I mean, where inflation is really showing up is in asset prices. They have reacted strongly everywhere you've seen. I mean, some of the previous speakers talk about equity valuations and how much it has increased, or bond yields or things like that. What I think the feeling generally is that valuations are clearly stretched. Are we already in the fraud and bubbles? We don't know. But it's certainly an area which we are not very comfortable at the moment. And if it's true that we are going to stay for some time in these expansionary global monetary conditions, it is fair to assess that we will continue with asset prices being more stretched. However, markets are starting to tell us something a little bit different. They're starting to tell us that they're beginning to worry about the exit. They're even calling the trade a reflation trade. Is this probably the first sign that we're about to have an exit or not? But at least let's think about it. What will be the consequence to emerging markets when exit from these kind policies occur? Well, this is where I don't think we have a very difficult time. We have seen in the past not only the tamper from the QE, but we have seen several times when the US interest rates or other global interests have risen. In my experience, I've seen in the 2018 rise in interest rates was very light, very temporary, but I've seen a lot of emerging markets in crisis. We got the Argentine crisis, we got the Turkey crisis, and this was something that I don't think people even remember as an exit. It was just a very light and temporary increase. What was the consequence? Depreciation, higher interest rate, tightening of financial conditions. It was an abrupt change. And when you think about Brazil, I think we are in a position where we are not really ready for a big change. We're in a fragile fiscal position. There are a lot of issues about political uncertainty. And I have to say, inflation is going up and interest rates are already on the rise, the market interest rates. And the central bank is about to raise interest rates, if not in the next meeting, certainly in the one after that. So what is that? What is the reflation trade? Well, I mean, everybody that look at the market today, I mean, even this graph is out of date. I mean, we have seen the 10-year reaching close to 1.6. So the very, very low interest rate wall is getting to an end. This is, of course, a sign that markets are telling us that they fear the exit, or they at least believe that the exit is closer than what the Fed is saying, what the ECB is saying. The market is saying, well, maybe we are closer than regulators believe. And where is the fragile point? Here is Brazil gross debt. I can show you the net debt, but we are in a record level of gross debt this year. Last year, it ended at 89% of GDP. So we do have an issue of financing. We do have an issue of fiscal policy. The instrument is really not there. So this means that risk is there and you have some premium on interest rates. Of course, in the case of Brazil, what we have seen is that the thermometer has been the currency. Interest rates have been kept very low. Fiscal policy have reacted, even though we have a high debt. But the currency has been floating, even though the central bank intervenes. It has intervened for some time, when I was at the central bank also. But look at the undervaluation of the real compared to the other currencies. And this shows you that the real is showing that the Brazilian economy is under a more fragile situation than the rest. What about inflation? Well, Guillermo mentioned inflation is very low. Francesco mentioned that we are very far from the exit. But when we look at the case of Brazil, when we had a very low inflation here, even below below the lower bound, very fast. And this graph just shows you less than 12 months. And this is the break-even inflation 12 months going forward. And here we are very close to the upper bound and higher than the target of the central bank. And that's the reason why interest rates have started increasing. And the language of the central bank has increased. The forward guidance, there was a forward guidance, where it basically said, we're gonna stay put, we're not gonna raise interest rates, but inflation has been on the rise, and that has prompted a change in interest rates. And the market has caught that. This is 6 months ago, not, let me just go back, not 2 years ago, not 3 years ago, just 6 months ago. We were very low here. This is the very short end, 2%. And the curve was very steep, reaching even 8% by 12th year. And now we are having not only the short end pricing an increase in the central bank rates, but even the longer rates are pricing an even higher rate. So when we talk about the exit, globally, we are looking at the reflation trade. And in Brazil, we are seeing inflation going up and interest rates also showing that the exit seems to be much closer than we thought. So that's my initial remarks, and I'm ready here to answer any questions. Thank you very much.
So thank you all. That was great. I have more than a couple of questions, but we also have a couple coming in through the Q&A, so I won't hog too much time, but I am going to take moderator's prerogative and ask. And here I want to be a little bit devil's advocate. I think many, perhaps not Ilan, but most of you think that exit's pretty far away, partly because a lot of the consensus is that the recovery in many economies may be slower. It's not going to be a pop in V, a V-shaped recovery, if you like. And but let's play devil's advocate and suppose we're wrong and the markets are right. Will, then fiscal policy, particularly the fiscal policy planned in the United States by the Biden administration, is a lot. And another X number of months of very, very large asset purchases by many central banks, particularly the advanced economies, is a lot. What happens? I'm going to add a question from the audience too to that, which is, if the central banks are convinced they're right, are they going to push back and try to push long yields that have risen now down? Okay, whoever wants to take that. I'm looking at Seth.
Very good. Well, first off, in terms of how far off exit is, I think one place where I am away from the market is thinking that the taper comes earlier, right? So I'm on record as saying I think they're going to announce the September meeting that they're going to start tapering, which is before most of the market thinks. I suspect a little bit of the recent price action could deal with that. So in that regard, I think QE tapering is sooner than the market realizes. I think Fed liftoff though is probably further off. And so what happens, and the inflation side of things, I guess I will take the under on inflation relative to just about anybody for a few reasons. One, it seems like at least in the US, you get inflation when on a sustained basis, aggregate supply outstrips aggregate demand for long enough that businesses feel like they have pricing power, and then it gets built into the psychology. In the United States, which I will admit from a structural perspective is very different than lots of other jurisdictions, the measured monetary aggregates tend not to help very much with that kind of forecasting. And so I actually feel like the fiscal package being debated now, a huge chunk of it is actually, how you figure out how much it's going to boost things and if it's going to get you overheating depends on your starting point. I think if you were to look at the world with no fiscal policy at this point, you actually get contraction in the US. And so so you can't take the current level of GDP and add on 1.9 trillion and go, oh my gosh, that's past potential. Second, state and local governments are going to get a ton of money, and some of them are going to use that to keep from borrowing more and to keep from paying things, and to pay some things down. So oddly, given the shape of this shock, given the number of households who are going to get some checks and that are 2, 3, and 5 months behind on their rent, and so they're going to basically be using current transfers to pay for past consumption spending, I actually suspect the net effect of stimulus is going to be much smaller than people realize. This is the one time that political semantics matches up with economic analytics. This actually is more relief than it is stimulus. And so, yeah, I think it's going to matter. I think we're going to get a strong growth this year, but I think that's going to be enough to close the output gap early next year. We'll start to go through it. And then with as flat as the Phillips curve has been in the United States, yes, you'll get inflationary pressures and the Fed will be able to lift off the funds rate at the end of 2023. But boy, I'm not super worried about Larry Summers style overheating, the Fed having to hike interest rates next year.
Patricia, maybe I should just jump in.
Please.
I think the central banks will fight the market while they can. While when you see output gap is there, inflation is not there, they will just fight it. They will not fight it where it's clearly not there. So what I just showed you in the case of Brazil, there's inflation going up, and then they will just raise it. And if Seth is right, then you get some indication of more growth, more in the future, then it's going to be more in the future. So my take is that this will be a very classic response by central banks. They will fight it while they're seeing their indicator. They will not look to asset prices and worry about bubbles and all other type of inflation.
Yes, please.
Yeah, if I may, I think, it's quite clear that the Fed will have to accompany this big effort, stimulus, fiscal effort in some fashion, right? If it doesn't do that, then interest rates will rise and blah, blah. So here we are, as was mentioned before, I think Francesco mentioned it in his presentation, that there is a de facto linkage between the Fed and the Treasury. So they are going together, they are joined at the hip and going together into this adventure. So the more they go together, the more the Fed overloads with fiscal paper, the more it will have an impact tapering. The tapering eventually will have an impact on Treasury prices. And if at that point, therefore, I don't know how they will manage that, but you have to be a real, very delicate surgeon, I think, because now you have a much bigger problem. You're going to now the central player into this. There's a lot of money there, and the impact of monetary policy on Treasury bonds prices may have repercussions in the stock market and create a collapse there. And the Fed will not be, cannot look to the other side. In that case, the Fed will have to come back into the market. So I'm concerned that if we keep pushing that lever, that is again based on liquidity, and in the short run, we all love to take a bath in the Fed liquidity. When you have to take the liquidity out of the bathtub, if the bathtub is very large, you can have a problem, a more serious problem at least.
Yes, Francesca?
Well, to answer your question, one way to conceptualize it is think in Vixelian terms. There is a natural rate and then there is a monetary rate. And the answer to your question is, how much lower is the monetary rate with respect to the natural rate? So how much are central bank forcing rates down with respect to what the economy on its own would produce? Now, this is, of course, a very hypothetical question because we don't know what the natural rate is. My reading is that the natural rate is not much higher than what the monetary rate is. So the weight of central banking in pushing interest rate down is there, but it's not very strong. What that means is that if central banks don't push anymore, then interest rate, yes, will go up, but will not go up by a lot. Yes, Treasury rates 10 years are at 1.5, 1.6%. which is very low in any case. And if in Europe, bonds, instead of yielding minus 30 basis point, would yield the 0 or even 50 basis point, this would still be very low. But this is only the beginning of the story, because then what happens is that this changes, say in treasuries, in bonds, they multiply up when you go to emerging economies and when you go to countries like my own, Italy, that has a very high debt. So yes, the increase would be limited, and in a way we will get away from this very peculiar situation of rates very close to 0. But the effect on emerging economies, because of the multiplying effect and the effect on heavily indebted countries, even in advanced economies, could be very strong. So limited in some advanced economies, but could be strong in less solid advanced economies and in emerging economies.
Thank you. So one more financial stability question. I can't resist, since I was in the financial stability business for a while. And this is a truly global question. Advanced economies, emerging economies. One of the biggest trends since the global financial crisis is the really significantly large increase in leverage in the non-financial corporate sector in virtually every country around the world. Big increase in leverage. They were not the story during the global financial crisis, but they're definitely one of the stories in this one. And of course, number of the relief packages, not all the fiscal policy, but central bank actions have probably increased that leverage by as well. And so on the financial stability front, I have to say the thing personally that kind of worries me a lot is what happens in the sorting out, both in emerging economies and advanced economies. You know, this is a structural crisis as well as a cyclical one, and businesses are going to change. And so I'm curious about your views, whether you agree with me or disagree with me, and why that this may be one of the biggest risks. There's certainly a risk to governments and capital flows, but I actually am concerned that the biggest risk may be actually to the corporate sector and maybe even more a small business sector, but either one of those. Thoughts, comments?
Well, I can jump in. I think financial stability will be something we'll be talking about in the future a lot. I think the exit from what we're seeing today will be felt in the future. And we will be looking back and saying, why we didn't do more? And the reason, of course, is what we're looking today, saying, well, we are worried about expansion, we're worried about COVID, we're worried about low inflation, we're worried about a lot of issues that seem to be more relevant at the moment. But I'm quite confident that at some point in the future, we'll go back and say, well, these financial stability issues we are facing is because we did not give enough attention in the past. So there are people already talking about bubbles and asset valuations that don't make sense and things like that, and we just discount it, and we're back again to the same issue. You just discount it and say, well, not really, it's new normal, this time is different, and all of that. So I think I'm not sure if we can do more this time around, but I'm sure in the future we will be looking at financial stability and say, well, what happened?
Any other comments? No other. No. I was riffing off of something that Francesco's up, so I thought he would have something. He'd have something to add about.
Well, what I can do is that we had exchanges in the past about this, Trish, you remember, about macroprudential setup. And I think there are intrinsic limits to what you can do with macro policies. But my understanding is that both in the United States and in Europe, we are far from having reached these intrinsic limits, in the sense that the policy set up for conducting macroprudential policies is not right. I mean, the Financial Stability Oversight Council in the United States, the ESRB in Europe, what the ECB can do is not up to the task. So of course, I mean, I fully realize that you don't change these things very quickly. But if I would have one advice, put urgently in action things that will improve the macroprudential setup and would bring us at least to the intrinsic limits that is in any setup, but bring us there. And of course, when we get there, we would say, okay, we cannot do more, but at least we would be able to do that much.
Seth or Guillermo?
Well, so one question I've had for a while, and I've only ever been a dilettante in the financial stability space, unlike those of you on the panel who are deep experts. But one of the key places where everyone agrees that you need to do something about financial stability is because it can ultimately hinder the real side of the economy. And the Fed any number of times has said we need to save Main Street, not just Wall Street. And yet most of the focus on financial stability and leverage is on the financial sector for all of the obvious reasons we saw during the financial crisis. On the other hand, this time around, when we were worried about markets breaking, liquidity freezing up, the fact that the non-financial sector is so massively levered, I'm always surprised that there's never been a push for some sort of macro stability policy for someone like the SEC or others to have leverage ratios for the non-financial sector so that it's easier for the real side of the economy to weather these sorts of financial shocks. So that's a question. It's not actually a response, but.
No, it's well, financial crises tend to be real leverage and financial leverage too. It's just, we did it in real estate last time, but and households. And the truth of the matter, at least in the United States, where that was true, and I think it's true for every country that has a real estate bubble and a crisis afterward, it takes a really long time for the real side to recover, partly because they all have to deleverage at the same time the financial sector does. And that's sort of what worries me about the non-financial corporate sector, not now, but you know, in a couple of years when we're a little bit closer to something kind of normal. Sorry, let me look at the questions. Oh yeah, so Ilan, there is a question here for you, and I know that you have to go in a few minutes, so maybe I'll pose it to you. It was a question here that is about the real and your picture about depreciation and whether it was really overvalued before, and so where it is now is not quite so crazy, particularly given where rates are, and isn't that sort of a good thing?
Yeah, I saw the question here. It's from Roberto Zaga. I think it's a great question, and I mainly agree with the basics of the question. It's we have since the 90s in Brazil we have had very high real interest rates, and this of course had the consequence in terms of flows, in terms of how much. We get portfolio flows, how much banks use their balance sheets to bring money, how much Brazilians actually leave their money in Brazil. So at the end of the day, interest differential had a lot of influence on how much you actually bring dollars to Brazil. Unfortunately, over time, we have seen this high interest is going down slowly and steadily. And in the last several years, we have seen this actually collapse. So interest differential is now very low. If you want, in the market talk, the carry of the real is very small. You can hedge very easily the real. It's not very expensive. So at the end of the day, that has a very important consequence on on the currency. And we have seen it gone from 1.6 to 2, from 2 to 3, from 3 to 4, from 4 to 5, from 5 to 5.5. And what Roberto is saying is that there is an interest differential. Consequence, it's a good thing. Emerging markets tend to be cheaper than advanced economies. It did not make sense to see Brazilian prices to be as expensive as Zurich, Tokyo, whatever. So I think we are back to some normality. Having said that, there is, of course, some volatility in the exchange rate lately. And this volatility is related to perception on fiscal fragility. When you look at what happened lately, commodity prices going up quite a bit. Real was supposed to appreciate on that. That's why we see hedge funds and market participants betting that the real will come back. And this did not happen. And it did not happen because there is some perception that there is more risk in the economy than we could just infer from commodity prices and other. So my answer to Roberto is yes, you're absolutely right. The currency is in another level, but my comment before was more on the volatility on the last 6 months, 12 months.
So, actually, this is a question that Seth sort of answered from his perspective, but there's one directed directly to you, Francesco, about how much you're worried about U.S. fiscal policy relative to what's, I'm going to say relative to the euro system, where the fiscal packages are large, but certainly more modest than what the Biden administration. Are you more worried about inflation in the U.S., even if it comes back, or no?
I think one important issue would be what happens to the dollar-euro exchange rate. Because if we are in an ISLM world and fiscal easing leads to an appreciation of the dollar, well, then what Europe would have would be more demand in the United States, more expensive dollar, cheaper euro, and this would help activity in Europe, and to some extent compensate the fact that if you are a bit exuberant in the United States about fiscal policy, we are a little stingy maybe in Europe. But of course, we don't know if that would happen, because we also know that in a ISLM world, if the central bank does ease while the fiscal policy eases, then you don't have the effect on the exchange rate. So I see that there is a little more of a burden on the ECB, and that's why I said that maybe the view that exit is further away in Europe is more based on facts than maybe in the United States, where it is more based on interpretation, is because there is a little more of a burden on monetary policy than on fiscal policy in Europe. I'm not belittling the importance of the Resilience and Recovery Fund. That's terribly important, but it's not terribly important from an anti-cyclical point of view. It's terribly important more from a structural point of view, more about what it tells you about the maturing of the economic framework in Europe. Also because much of that will not come in this year, will come 22, 23. The burden on anti-cyclical so far has been on national fiscal, not on the what you could call federal, if we may use this word for the European Union.
Thank you. Okay, so we have time for one more quick question. So I'm going to ask a more central bank philosophy question, I think, maybe. both Francesco and indirectly, Guillermo talked about central banks and, well, they talked about monetary and fiscal policy being like this right now. But in particular, central banks increasingly, since the great financial crisis, but certainly in the last year, are much more in the resource allocation business than perhaps, than they, at least in the advanced economies, than they have been, and perhaps more than they're comfortable with. That's a question. So it's just not monetization of fiscal policy, it is credit allocation. And all kinds of discussions about, you know, central banks' role in things like climate change and the role of the financial sector and so forth. So I'm really interested in everybody's view. Is this a good thing, a bad thing, something we should ignore? Is it going to get central banks in trouble?
If I start on that, I mean, I was raised as a central banker with the view that the accord between the Treasury and the Fed was a good thing, that the divorce between Banca d'Italia and the Treasury was a good thing. So you should keep separate the fiscal from monetary policy, that the central bank should not enter into resource allocation, should not care about income distribution, that the twist one was a sad page in the history of central banking. So I was raised with that model, and now there is the exact opposite of that, and that doesn't make me comfortable. Also because I think that, for instance, when it comes to monetary policy helping fiscal policy, I think this is necessary in current conditions. But I'm worried that once you start, it may not be easy to stop. And in Europe also because of the spreads, I think Seth referred to spreads in Europe, but that has never been an issue for the Fed. So yes, I'm uncomfortable with this new. The only hope I have is that this is temporary and that we could move away from it. But of course, I mean, we have been there now for 12 years, at least when it comes to fiscal monetary policy confusion. So it's a long while. But yes, I'm not comfortable.
I think the central banks are facing the same issues that other players are facing. Companies we were raised to believe that they should maximize the shareholder value, and now they're being pushed to social issues and other things and ESGs. And I think central banks are being pushed in the same direction. I don't think it's very particular to that. I think this you're basically pushing everybody into issues that are more relevant at the moment: income distribution, climate change. And I think what we need to evaluate is how companies, open companies, public companies, central banks, how can they do their best in that direction? If you do too much, you will, of course, disappoint not only central banks, but even expectations people put. Maybe you don't have the instruments to do that. So what we really need to know is what we really can do. Is it, of course, easy to say there's nothing we can do, we must go to the past, but I think we are not going to get by just by saying that. So I think the best thing to do is think what realistically you can offer in terms of what the society is asking central banks to do.
Yeah, it's a very hard thing to have a strong opinion about. I think the pandemics have really messed up the whole thing. I mean, without the pandemics, we look at central bank independence as a way to keep sure that there is no time inconsistency. Well, the pandemics just what we find is that we don't have enough instruments. So the first thing that some countries do is a wealth tax. All of a sudden, a wealth tax becomes something very attractive. But that's basically time inconsistent because that was not even considered in the past, certain things that you may have to do. So beginning with the fiscal policy itself is in a state of flux in a situation like this. You have to take the money from the right hand and give it to the left hand, and there is something terrible happen on the left hand. So there is our arguments, economists' arguments, are totally second order. So we have to do that. And once doing that, then the question is, what about the balance between the fiscal authorities and the central bank? And I can very well think of a situation that if you're going to be giving away money to not spending, but the fiscal policy expenditure is not in infrastructure, but just subsidies, then you probably need the help of the central bank. Without that, by just throwing treasury bonds into the market, you will be able to make the transfer, but you will risk lowering the market value of that and having a negative effect on the other side of the economy, which could be very complicated by itself. So I think that the central bank will be forced to be together in order to do something which nobody likes, but is more efficient, perhaps, than letting the fisc do the whole job.
Seth? You don't get off.
Yeah, I guess. I guess for some of the reasons stated, I'm very uncomfortable with it, and then maybe through the idiosyncratic American lens of it. So, despite all of the evidence, I'm still naively in love with the mythology of American democracy and the undemocratic status for potentially good reasons of where the Federal Reserve and in many countries central banks stand, i.e. lots of political insulation, very little direct political accountability. For all of those reasons, I think it is very good in a democracy to isolate and make very precise what the responsibilities and authorities of a central bank are. And for things like equity, equality, distribution, picking winners and losers, I think those ought to be entirely in the space of the elected officials who at least have a semblance of democratic accountability. And when the blurring of the line that I see tends to happen very often when elected officials don't have the courage to do something difficult. And so they try to get the benefit if it works well and put the cost off on the central bank. And I think that just generally undermines institutions in a way that's undemocratic and leads to bad outcomes.
If I may, I agree fully with Seth's point of view. As a normal way of dealing with the relationship between the central bank and the fisc, that's perfect. But when you have a shock which is totally unprecedented, I mean, you're not really breaking a rule because there was no rule. We never thought about this. So, because if there was a rule, at least, right, we would feel more comfortable. So, but given that there was no rule in extreme circumstances like that, maybe certainly I agree with you, Seth, that we should chastise the central bank for doing that. You shouldn't do it. But I guess there is some justification in this case.
I will add that, of course, Seth's view is a central bank view, and it's the most where we all grew up and we all worked. But unfortunately, I don't think we can get away with that current days. And I think we're not going to get away with that for the next 10 years, 20 years. So we need to think more about what we really can do and what we cannot do, and that's separated very, very clearly.
Said like a former central bank governor.
One footnote to this. In many ways, central banks in advanced economies are doing what central banks in emerging economies have always been doing. It was a peculiarity of advanced economies that central banks would be so remote from those policy charged actions to which Seth referred to. That was common in emerging economies. Then the hope is maybe that this will not last for the next 10, 20 years. If we could shorten a little, Ian, this period, I would be very happy.
Very good. Well, now we are definitely over our time. And I want to, again, thank the conference organizers and sponsors. Thank you so much, the four of you. This was a real treat. And thank all the participants for attending. Tom, you want to have the last word here?
I do appreciate it, and amazing interaction. Thanks to the four. Thanks, Patricia, for your wonderfully deft moderation and questions. Just to, in addition to thanking our partners in Brazil, CDG and CDPP once again, and all of you, just remind you that tomorrow morning, these are paired conferences. We have one in the afternoon on Thursday afternoon and another one on Friday mornings. Tomorrow morning, Francesca, we're looking at the second fiddle. We're looking at fiscal policy issues, and particularly we'll be delving into the case of the fragile fiscal framework that Ilan Goldfein has referred to that concerns him so greatly, and maybe even considering issues, Guillermo Calvo, of how much debt is too much in the case of Latin America. And so many of the themes that were picked up today, but maybe more focused in on fiscal matters. That's you got the invitation already. It was part of the invitation to join this afternoon's conference. It requires a separate registration, and it will be tomorrow. The final thing I'll say, and then ask Jan to really definitively say, and the conference, is that we will be producing summaries of today's remarkable events. It's something that sometimes it's a chore to do that, but when you heard such insights and spontaneous interaction between experts, it's really going to be a pleasure to do that, and I think very important to do that. So we will be producing a summary and distributing it to all of you once it's been thoroughly reviewed. So thank you very much. And Jan, the final word I think is yours tonight.
Let me just thank you all. This was very substantive. It was very informative. I think you've delivered in terms of the substance, experience, but you also posed questions, I think, which remain to be answered, and we'll see how things will go. Indeed, we will have the fiscal side tomorrow, and let me also say, going forward, we'll have sessions on issues of income distribution, wealth distribution, labor markets, the allocation of resources that several of you mentioned, and which obviously the micro underpinnings of the macro structure will be very important to understand going forward. So thank you very much. This was a great kickoff, and we're looking forward to seeing you again, either as panelists or as participants in the future roundtables. Thank you.
Great. Thank you.
Be safe, everyone. Thank you again.
Bye.
Bye-bye.